Hey everyone, it's Fook. It's Sunday, July 1st, and I'm in Manchester. I just finished up dinner. It's about 6 p.m. Still have a bit of wine left, so you may see me enjoying that through the video here. But this is part three of my planning for retirement series, and in this video, I'm going to talk about the different retirement vehicles, accounts that you can set up to put your money in to save for retirement. So there are two main types of accounts for retirement savings these days, and they're the 401k and the IRA. It used to be that in the past, a lot more people would have access to pensions, whether they're private or public pensions. And pensions are known as a defined benefits plan. And they're called that because you have a defined benefit from when you retire, as long as you vest and meet, the criteria to get the pension, that you will get a defined benefit for the rest of your life, and that's why they're called defined benefits plan. These days, since the early '80s, really until now, the 401k and its cousin, the 403b, have really taken over. And pensions are becoming less and less, although you still see them in some public institutions. In fact, I have a pension from the California State Teachers Retirement System, also called CalSTRS, from my teaching days. So, they still exist, but they're getting rarer and rarer. And what has replaced the pension is now called a defined contribution plan in the 401k, or its sibling, the 403b. And it's called a defined contribution plan because the benefits that you get out of that plan when you retire is based on the amount of contributions that went in. And that's the main difference, and that's why they're called that. And by the way, the 401k and the 403b, they just get their name from the tax code, the section of the tax code that kind of defines these plans, and that's where they came from. And the main difference between the 403b and the 401k is that the 403b is primarily used for nonprofit organizations, whereas 401ks are used by corporations. But aside from that distinction, they have the same contribution limits and other rules and whatnot. So let's get into the 401k. In terms of 401k, in 2018, the contribution limit if you're under 50 is $18,500 for the year. If you're over 50, you get $18,500 plus a $6,000 catch-up contribution. So your total contribution to a 401k or 403b, if you're over 50, is $24,500, which is a lot of money. So in terms of contributing to a 401k, what should you do? Well, you should contribute as much as you possibly can. That's the basic advice. But if you can't do that, because it's a lot of money to try to max that out, if you can't do that, you should at least try to contribute as much as you can so that you can get your company match. Most companies these days will have some type of matching plan to incentivize workers to contribute to the 401k plan. And it can come in a variety of different schemes, but some of the popular ones would be the company will match your contributions dollar for dollar up to some percentage of your income, 3 or 6% or something like that. Another popular one would be the company would match your contributions, but at a rate of 50 cents on the dollar up to a fixed percentage, 6% or whatever the case may be. So if you have a matching contribution from your company, that's great. And the advice there would be to at least contribute as much as you can so that you can get the match. And the reason for that is pretty simple. It's basically 100% return on your investment immediately. And if you don't contribute to get the match, you're kind of leaving money on the table. So that's kind of the basic advice on a 401k. For 401k, traditionally, all of the contributions are tax deductible. So even if you contribute $10,000 to a 401k, if you get the tax deductible benefit, the take-home pay that you're losing is not the full 10,000. It's a bit less than that based on your tax rate, but it could be, you know, $8,000 difference or 7,500, something like that. But you get that tax benefit up front. There's another flavor of 401k lately, which is the Roth 401k, and this is similar to the Roth IRA, which I'll talk a little bit about. But the main difference is that with the Roth 401k, all of your contributions are with after-tax dollars. So you get no tax deductible benefit up front, none at all. But the benefit is quite large, actually, if you can do it, which is that all of your earnings will be completely tax-free. And on top of that, you can also withdraw your contribution at any time since it's made with after-tax dollars. The main drawback is that your plan has to support the Roth 401k option, and not all plans do. So that's basically the 401k and its sibling, the 403b. So what about the IRAs? Well, there are two flavors of IRAs, individual retirement accounts. One's the one that everyone knows from their work, and the other is the SEP IRA, which is for self-employed individuals. I'm not going to talk too much about the SEP IRA. Actually, I'm not going to talk about it at all because for most folks that are self-employed, they have some kind of accountant or other financial advisor that will give them great advice on setting up a SEP IRA and the contribution limits to that and all that. It's much higher than a traditional IRA, but it doesn't apply to as many people, so I'm not going to spend a lot of time on that. So with the individual retirement account, the IRAs, there are two flavors. You have your deductible IRA and you have your Roth IRA. And they work very similar to the 401k, the main difference being that the contribution limit is a lot less with the IRAs. So with the IRAs in 2018, the contribution limit is $5,500. And that's it, which I don't think is nearly enough, but that's what we have. So the beauty with the IRA, though, is that depending on your circumstances, you are able to contribute to both a 401k and an IRA, and it's in your best interest to do so if you can do it. There are some details with that in terms of whether or not your contribution to the IRA is tax deductible depending on your income limit. And on the Roth IRA, there's an income limit in terms of whether you can even contribute to a Roth IRA at all. The income limit is relatively high. For an individual, it's around $120,000, thereabouts, maybe 130, something like that. You can look it up. That's a technical detail. But there is an income limit in terms of contributing to a Roth IRA or to get the tax deduction on a traditional IRA. So what happens if your income is too high to qualify to get the tax deduction on a traditional IRA or to even contribute to a Roth IRA straight off the bat? Well, you do have an option, and that option is to contribute to what people call the non-deductible IRA. The limit is the same, it's $5,500 a year, and it basically means that when you contribute to a non-deductible IRA, you do not get the tax benefit up front, and your contribution is made with after-tax dollars. But you should still do it if you can swing it. And the reason for that is that the IRS does allow what's called a backdoor conversion, which your broker can do very easily for you, and you can do it as many times as you wish. And basically the way the backdoor conversion works is this. You're able to convert a traditional IRA to a Roth IRA as long as you pay any taxes due immediately in terms of contributions and earnings. So if you made in the past contributions to a traditional IRA that had the tax deduction because you were under that income limit, for example, and then it accrued earnings, then you would have had to pay taxes on that contribution and also on the earnings when you convert that IRA to a Roth IRA. Now, if your income was too high to contribute to the deductible IRA and you had to use after-tax money, then you have zero tax liability when you convert it because you already made the contribution with after-tax dollars. On top of that, if you convert as quickly as you can after you made your contribution to a non-deductible IRA, then there's also no earnings and therefore no taxes due on that. And like I said, you can do that as often as you wish, so every year, in fact. So that's a great way through the back door to get another sizable chunk that you can save for retirement if your income permits it. So when you can combine the IRA limits to the 401k limit, you can potentially save up to $24,000 a year if you're under 50, and up to $30,000 if you're over 50. So those are the main types of retirement vehicles that are worth talking about. You also have some other vehicles like the HSA, which is the health savings account, but a lot of people don't qualify to it because in order to even open up an HSA, you have to have a high deductible healthcare plan. Not a lot of people do, but if you do qualify, I think the contribution limit is something like $3,000 a year, but it's very advantageous tax-wise to open up an HSA if you're able to. But like I said, not a lot of people do, so I'm not going to spend a lot of time on that. In any case, that's part 3 of the series in terms of planning for retirement and the vehicles that you can use to get there. If you have any questions, feel free to leave it in the comments. Otherwise, I'll see you back in a week or two for part 4. See ya.